Every time you hear about the national debt, the numbers sound unreal. Trillions of dollars, numbers so large they stop meaning anything, and yet this money is still owed to someone. So here's the simple question almost no one can answer clearly. If every country is in debt, who exactly is getting paid? Because when you zoom out, the situation starts to feel impossible. The United States owes tens of trillions, China owes trillions, Japan, Europe, developing nations, all in debt. If everyone owes money, who's on the other side of the transaction? Who's the lender in a world of borrowers? Today, we're going to untangle that question, not with conspiracy theories, not with vague explanations, but by following the money step by step to understand how global debt actually works, why it keeps growing, and why the system hasn't collapsed, at least not yet. Before we break it all down, here's what this video's about. We're not just asking who countries owe money to. We're asking how a world where everyone is in debt can still function at all, and what that reveals about how the modern global economy is really built. If you enjoy clear, factual explanations of how the world actually works, make sure to subscribe. Like the video if this topic interests you, and drop a comment if you've ever wondered how this system can keep going. To understand modern debt, we need to start with something simple: debt itself. Debt isn't a modern invention. It didn't start with banks or stock markets or governments. At its core, debt is just a promise to give something back in the future. Long before money existed, people borrowed from each other: grain, livestock, labor. You help me today, I repay you later. That's debt in its simplest form. Borrowing from tomorrow to solve a problem today. As societies grew larger, so did the scale of borrowing. Kings needed armies, empires needed roads, ships, and fortifications. But no single wealthy person could fund all of that alone. So rulers began borrowing from many people at once. This idea evolved into government bonds. A bond is simple. You lend money to a government. In return, the government promises to pay you back later with interest. This system allowed states to raise massive amounts of money without immediately raising taxes. By the 17th and 18th centuries, bonds were already common in Europe. By the 20th century, they became essential. 2 world wars pushed government borrowing to unprecedented levels. Countries didn't just borrow to fight, they borrowed to rebuild entire economies afterward. After World War II, the global financial system was redesigned. In 1944, the Bretton Woods Agreement made the US dollar the central currency of the world economy. Many currencies were tied to the dollar, and the dollar was tied to gold. But this system had a limit. Gold was finite, economies were not. As global trade and government spending grew, there wasn't enough gold to back all the dollars in circulation. In 1971, the United States ended the direct link between the dollar and gold. From that point on, most global currencies became what's known as fiat money. Money backed not by a physical commodity, but by government authority and trust. This change made borrowing easier. And once borrowing became easier, it became normal. From the 1980s onward, global debt accelerated rapidly. Governments discovered that borrowing wasn't just for emergencies or wars. It could be used to manage recessions, stimulate growth, and smooth out economic cycles. Today, debt is how governments build infrastructure, fund social programs, and respond to crises. It's not an exception, it's the default. As a result, global debt has climbed into the hundreds of trillions of dollars. That figure includes government debt, corporate debt, and household debt combined. It now exceeds the total annual output of the global economy by several times. So we return to the central question. If everyone is borrowing, who are they borrowing from? The answer is less dramatic than many people expect. There isn't a single hidden group or shadowy lender controlling the world. Modern debt doesn't move in straight lines. It moves in loops. Let's start with one country to see how this works: the United States. The US is often described as the most indebted country in the world. But here's the key detail that's often missed. Most U.S. government debt is owed to Americans. When the U.S. government borrows money, it does so by issuing treasury bonds. These bonds are bought by investors, and the largest investors are domestic institutions. Commercial banks hold large amounts of government debt. So do pension funds, so do insurance companies, mutual funds, retirement accounts, and even central government programs. When you deposit money in a bank, that money doesn't sit idle. Banks invest it. One of the safest investments available is government bonds. Pension funds do the same thing. They're responsible for paying retirees decades into the future. They need stable, predictable returns. Government bonds provide that. Insurance companies rely on bonds as well. They collect premiums today and need reliable assets to cover claims in the future. So when the government borrows, it's often borrowing money that originated as household savings, money that might otherwise be sitting unused. When the government pays interest on its debt, that money flows back to these institutions, which then reinvest it, often by buying more bonds. This creates a cycle. Money moves from savers to the government, then back to savers over and over again. In this sense, a large portion of national debt is internal. The country owes money to itself. Of course, not all debt stays within borders. Countries also borrow from each other. Foreign governments, central banks, and international investors hold government bonds from other nations. They do this for the same reasons domestic investors do: safety, liquidity, and predictable returns. For example, countries with trade surpluses accumulate large amounts of foreign currency. Rather than letting that money sit idle, they invest it. Government bonds from stable economies are a common choice. This is why international debt relationships often run both ways. One country may hold another country's debt while also owing debt of its own. Zooming out, the global system starts to look less like a pyramid and more like a web. Savings in one country become loans in another. Interest payments flow back and capital gets recycled. This is why it's misleading to think of global debt as a single unpaid bill waiting to explode. Most debt exists within interconnected systems where money is constantly moving. But this raises another question. If governments keep borrowing, how do they ever pay it back? The short answer is, they usually don't, at least not in the way individuals do. Governments rarely aim to eliminate their debt entirely. Instead, they manage it. When a bond matures, the government repays the lender. But to do that, it often issues new bonds. New debt replaces old debt. This process is called rolling over debt. As long as lenders are willing to keep buying bonds, the system continues. This might sound reckless, but it's not accidental. It's how the modern financial system is designed to function. The reason it works is growth. If an economy grows over time, the government's ability to collect taxes grows with it. As long as debt grows more slowly than the economy, it remains manageable. Problems arise when growth slows, borrowing costs rise, or confidence breaks down. Why not just stop borrowing altogether? Because modern economies are built around the assumption that borrowing will continue. Government spending injects money into the economy. Businesses earn revenue. Workers get paid. That money circulates. If governments suddenly stopped borrowing and spending, the flow would reverse. Spending would drop. Businesses would earn less. Layoffs would follow. Tax revenue would fall, making the debt problem worse, not better. History shows what happens when borrowing abruptly stops. During the European debt crisis, countries that lost access to bond markets were forced into sharp austerity. Spending cuts, wage reductions, rising unemployment, and deep recessions followed. Debt, for better or worse, has become a stabilizing force. It cushions shocks and spreads costs over time. This doesn't mean it's risk-free. As debt grows, interest payments grow with it. A larger share of government budgets goes towards servicing old loans rather than funding new projects. When interest rates are low, this burden feels manageable. When rates rise, it becomes more painful. Countries with strong economies and stable currencies can usually borrow at low interest rates. Investors trust they'll be paid back. Developing countries face a harder reality. They often borrow at higher rates and sometimes in foreign currencies. If their currency weakens, their debt becomes more expensive to service. In extreme cases, countries can fall into debt traps, borrowing more just to pay interest on existing loans. Confidence erodes, rates rise further. Eventually, repayment becomes impossible. When that happens, a country may default. A default means the government cannot meet its debt obligations as promised. Defaults don't just affect lenders, they disrupt entire economies. Access to borrowing disappears, trade suffers, living standards fall. Because of this, governments do almost anything to avoid default. They cut spending, raise taxes, restructure debt, or seek international assistance. Sometimes they turn to money creation. Printing money can help governments meet short-term obligations, but it carries serious risks. When too much money enters the system too quickly, inflation rises. Each unit of currency loses value, prices increase, savings lose purchasing power. In extreme cases, inflation can spiral out of control. History provides clear examples where excessive money creation destroyed currencies and wiped out wealth. Most modern governments try to avoid such outcomes by relying on central banks and monetary policy. But even moderate inflation can erode trust if it persists. This is why confidence matters so much in the debt system. Debt works because people believe the promises will be honored. If that belief weakens, the system becomes fragile. So who is global debt owed to? The answer isn't a single entity. It's everyone and no one at the same time. It's owed to banks, pension funds, insurance companies, governments, institutions, and ultimately to savers. To ordinary people whose money flows through financial systems. Debt isn't a static number, it's a moving process, a cycle of borrowing, lending, spending, and reinvesting. This system has powered economic growth for decades, but it also carries risks that build quietly over time. As debt levels rise, the margin for error shrinks. Economic shocks hit harder, policy mistakes become more costly. The question isn't whether debt is good or bad, it's whether the system can continue to balance growth, confidence, and stability. Because as long as people keep lending, the system keeps moving. But if that trust ever breaks, the consequences ripple through everything. And that's the real answer to the question. The world's debt isn't owed to a single creditor. It's owed to the system itself, a system built on trust, motion, and constant renewal. The uncomfortable truth is that modern economies don't run without debt. They run on it.